Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special economic weather report brought to you in association with the BNZ. Today we look at New Zealand's current account deficit for the March quarter. This measures our trade deficit or surplus and the deficit on our foreign account. So this is people who have invested money in New Zealand, either in companies they own or have lent us money in terms of debt. And so we measure dividends paid out and also interest payments paid out. And what we've seen in the March quarter is a dramatic improvement in New Zealand's current account deficit. We've gone from a deficit of 7.9% of GDP last year to 2.4% this year, at least in the year to March. It's a massive improvement. It was actually better than economists were forecasting. And there's a couple of factors here. Our export receipts are going gangbusters. That's because commodity prices are quite strong and many of our customers, particularly in Asia, are doing well. There's also a few one-offs though, particularly around the area of tax. Remember, the banks paid out more than $2 billion in tax after the courts decided they needed to pay back a bit more tax. And that's helped boost our investment income deficit. Remember, the banks, some of the biggest foreign-owned companies in New Zealand, and regularly billions go back in the form of dividends to Australia, but not this year because much of it stayed here in tax. And without those tax payments, the deficit would have been 3.3%, so not looking quite so good, but not as bad as the near 8% it was a year ago. And there are some good signs, particularly around the area of net debt. That's stabilised at 70%. Now, part of the reason for that is the banks are not using the hot wholesale money markets as much as they were. Remember during the boom from 2002 to 2007, when the banks were borrowing on these offshore wholesale markets a lot? Well, they've stopped doing that, partly because the banks themselves don't want to be so vulnerable if the markets freeze up again, like they did after Lehman Brothers, but also the Reserve Bank is pushing them to do it by forcing them to keep more of their funding back here in New Zealand. So they're competing more for term deposit funding from local mums and dads, and they're borrowing more longer term. Now, this core funding ratio is effectively forcing the banks to avoid borrowing offshore, and that's helping our net debt position. And as the core funding ratio improves or increases from 65% this year to 75% by 2012, that's going to help our net debt situation. It's also going to push term deposit rates up more than they already are now. And mortgage rates are likely to increase as the banks pass on some of those costs, the higher funding costs there. Essentially, though, New Zealand still needs to fix some of its structural imbalances, and we heard that from the Reserve Bank Governor a few weeks ago. He says, rightly, we need to spend a bit less on consuming things at home and investing in property. We need to save a bit more and make sure that's invested in exports. And generally, our economy needs to do more exporting and less consuming. That will help turn around our current account deficit. I'm Bernard Hickey. That was a special economic weather report brought to you in association with the BNZ.